I think from a China perspective and from a global growth perspective, obviously this is positive data for us to look at. I wouldn't get too carried away with it, to be honest. I think the Chinese authorities are still very focused on managing the credit boom that we saw in 2008, 2009, trying to slow that credit creation down significantly. So I think what we're going to see over the next 6 to 12 months, we're expecting the global economy to pick up pace, led by the US, but also Europe doing reasonably well. And that is going to obviously help Chinese exports. But I think then what you're going to see is the domestic economy sort of being tapered back a little bit in China to offset that. So I don't think we're going to see the growth accelerating beyond 7.5% for the full year next year, despite those positive external tailwinds that we're seeing. We still believe that the Chinese authorities are very focused on the quality of growth that we're seeing, and also therefore the longevity of it as well. So probably still softer growth than many are expecting next year, but healthy and above 7%. Yeah, well, I mean, it's actually the key divergence of opinion. If you look around different, research houses, everybody seems to be overweight global equities. Everybody seems pretty comfortable with a lot of the themes that are out there, strengthening growth, etc. But the one thing that is a significant divergence of opinion is emerging markets relative to developed markets. Clearly, we've seen strong outperformance this year on developed markets. Our sense is that that's still got some time to run, and probably in the near term that's going to continue as well. And the rationale for this is that we see tapering coming back on the agenda. Clearly, we don't feel it's going to happen in December, but sometime in the first quarter of next year, we would expect tapering to come back on the agenda, and we believe that is going to lead to underperformance of Asian equity markets. It doesn't mean negative performance. We should make that clear. We do feel that with earnings growth coming in around, expectations around 12%, even if you take a third of a haircut to that, you still come down to 8% earnings growth plus a 2% plus dividend yield. So you're still looking at 10% returns unless you get a massive derating of stocks. So overall positive returns, but probably still greater in developed markets. So if we're looking at, and you're absolutely right, the currency is absolutely key. So I mean, if we look at in local currencies terms, we're actually very comfortable with the valuations we're seeing, and feel that India is an attractive market. Obviously, a lot of bad news has been hitting the economy this year, and we'd expect that to improve at some point over the course of the next 12 to 18 months. The challenge is this tapering view doesn't hold a strong rupee as the core scenario. So we feel that's something that's going to come back to us. We're going to see weakness in the rupee again, and that is a factor that could lead to significant underperformance in line with the rest of Asia. We're not more bearish on India than elsewhere, but we do feel that there's still probably some volatility for the currency in the coming few months.